So today we're going to work on testing the hypotheses that we accumulated and discussed in part 1. There'll be 4 pieces to this. This one is the analytical review, kind of the overview of the financial statement amounts, and then the next 3 will be the general ledger inspection of 2006, 2007, and 2008. So let's get started. A hypothesis is not a statement of fact. It's an educated guess. So we made a number of educated guesses after reading the story. Now we need evidence. We need facts that support or do not support the things that we thought were fishy or potentially off, and whether or not the people we thought were involved were in fact the people involved. Typically, in a forensic audit, you would start quietly with notifying as few people as possible because, of course, you want to observe people in case they are still in the midst of a fraud, so you don't want to raise anybody's attention because once they know you're onto them, they will stop the activity. It may be difficult to find them doing it. So you would start quietly looking at books, records, contracts, paperwork, things that you can inspect without alerting anybody. After that phase, that's the phase we're in now. After that phase, you would start interviewing, and you would interview to verify the facts that you found in the books of records, and also to find out if they have new facts that were not able to be found in the books of records. And then as the interviews unfold, you update your hypothesis based on what you're finding. And so it becomes this iterative process. And the interviews will start with the least suspicious people and move towards the ones you are most suspicious about. And that allows you to have the most power because as you get to the people you're more suspicious about, you've already verified a lot of the facts. It'd be very difficult for the person that you're suspicious of to deny things you have collaborated through all the documents and through many, many layers of interviews. But today we're just going to be talking about the books and records. So we're going to start seeing what we can learn from the books and records to verify and support or refute the hypothesis that we have created. So we have 6 appendices here. Here's appendices 1, 2, 3, 4, 5, and 6. And these were sent out to you in the news. So you may want to, if you didn't already download and print those off, you may want to stop this and go get those, because you may want to be making some notes as we go through here. So what is this? This starts with gross receipts and it ends with net income. So this is their income statement, and it's 6 years worth of income. And we are most concerned with the state of the business in 07 and 08 because the prior owner died December 06. So the 2 sons are most concerned that things aren't what they expected to be. So let's just look and see what we got here. So if we look down at net income, the business made $97,000, $75,000, $37,000. So 05 wasn't a good year, but then it bounced back to $70,000, and all of a sudden it's down to the worst year and then the worst 2 years that they've had in 6. So that's got them wondering what's going on. And if you look at the top line, it's not that sales have dropped off. Sales are as high as they've ever been, but profits are as low as they've ever been. So you can start seeing why they would be concerned. It's hard to stare at these numbers and look and find something that sticks out. I mean, you can scan this and find things that stick out. For instance, you can look at rent. Rent appears to have doubled in 06, and that may be, or 05, so you can visually sort of see that sort of thing. You can see that taxes and licenses appear to have nearly doubled over the 6 years. So you can see things by inspecting, but sometimes it's easier to use percent. So if you look at the second appendices, it's the same format. This is still the income statement, but everything is presented as a percentage of sales. And so you can see relative to sales what things are bigger than they used to be. So if you look down at net income, for instance, it used to be 5, 4, 3% of sales. Now we're at 1% of sales. You can look up at the gross profit, for instance, and you can see that it's also at a new low. And you can see things that are at new highs. So anyway, you can inspect those. Let's look at the next one. This is a horizontal trend. So rather than having everything as a percentage of sales, you see the change from year to year. So from '03 to '04, the sales increased 3.9%. Okay, and so from '06 to '07, sales increased 6.5%. So that's a nice increase in sales. So I wonder if they are happy with that. But if you go back to the case, you can see here that the prior owner, before he died, believed that sales should be growing 10 or 15% with the addition of a pawn shop. So these are half what was predicted. So not only are profits at an all-time low, we're not seeing the sales from the pawn shop that the owner thought should materialize. This is a balance sheet, and so it shows the dollar amounts of cash and inventory and equipment and so forth over time. It also shows some liabilities, and we can kind of visually inspect that. You can see equipment seems to have jumped in '08, so they have bought something. Inventory is up, which you would expect because they added a pawn shop, and that will have some inventory. Cash is down a little bit, but it's kind of bounced around, so that's not immediately ugly upon inspection. Now, payroll taxes have gone way up since the owner died, and not paying payroll taxes is a very serious problem. Sales taxes appear to be up a little bit. Hopefully those are getting paid. I mean, sales are up a little bit, but I don't know if they're up that much, so there may be something in there we need to look at. Long-term debt is up, so they've been borrowing since the owner died, so we'll be curious to see what they're borrowing for. Capital stock hasn't changed, and then retained earnings is a function of profits. All right, so let's see what else they've provided for us. Here's a cash flow analysis. Now, they didn't actually summarize in what you would expect a GAAP presentation. So this is using the information from the tax return, because they're a cash basis taxpayer, to figure out what they should have at the end of the year for cash. And notice that in all the years except for '06 and '07, the analysis appears to have worked. So what did they do? They took beginning cash and they added net income and then removed the non-cash pieces out of net income. So they added back probably depreciation expense, if I had to guess. And then they reduced it for the change in inventory, because some of the cash that was earned was reinvested in building inventory. So inventory went up in all of those years by that amount. And then the change in current liabilities. So these were things that were expensed but not paid yet, so they shouldn't have come out of cash. And then changed equipment. Okay, there we see that big purchase, whatever it was in '08. We have a change in long-term debt. Some of the cash was used to pay down debt. So you can see during the years when the prior owner was around, they were throwing off enough cash to reduce loans. Now they're creating loans. So that's a big turnaround since his death. And of course the dividends have stopped, and probably because they don't have the cash, they're actually borrowing in order to operate instead of paying down debt. So that's a big change in their cash posture, and the question is why. So what they think they should have for ending cash based on this analysis is pretty close to true, except for in '06 and '07. The question is why? So these are the amounts that are on the tax return, and they pretty much just verify what we've already seen on the prior exhibits, but it's an additional one that's been provided to you if you care to look at it. So we have some facts and we have some trends that are not what we expect from the analytical review. So at this point we would say, okay, we need to look at some accounts. What accounts do we want to look at? Let's go back. So what do you want to see? Well, you probably want to see why wages are up so much. You probably want to see why taxes and licenses are up so much. I certainly want to see why advertising has gone from under $5,000 to $27,000. I clearly want to know why insurance is so much higher than it ever was before, right? You've got office expenses that are up quite a bit. So we have a number of expenses that are much higher than they used to be. So we want to see in the general ledger what's going on if we can. You can also tell from looking at the horizontal analysis the places where things have ballooned, like advertising, repairs and maintenance, insurance, miscellaneous expenses, office expenses. So these are things we're going to be looking into in more detail, asking them to pull the back up and looking at the general ledger. So the next video we will be looking specifically at the 2006 general ledger to see what we can learn from that.